everybody. So we are back and today we are looking at the journal. So the first thing I would like to do is to introduce, well, what actually is the journal? So the journal is basically doing some double entry, but not out of the ordinary double entry, but some extra double entry almost. Now, it could be because you've prepared the trial balance and you need to add something to it or adjust it. It could be when the business actually starts. It could be to correct errors, and we're going to be looking at that this evening. These are recorded in the book of prime entry called the journal book. So you know how you've got your sales day book, your sales returns day book, etc., etc. This is another book called the journal book. Okay. So, in an ideal world, somebody would keep a little journal book and they would put something like this every time they did one. So, for example, you could see the journal has got its own number. You've got the date it was put into the accounts, who's authorised that this adjustment can happen, and who the adjustment is going to affect. So, for this one, it's going to affect R. Sanderson. Then we've got the journal, and as you can see, you've got debits, you've got credits, the equal, the total, debits and credits equal. And then we've got a description of what this journal is for. Okay, so this one, the first thing we're going to look at is the journal for an irrecoverable debt. Now, what I want to just look at first of all is what is an irrecoverable debt. Now, an irrecoverable debt is sometimes called a bad debt, okay? And this is when you have sold goods on credit and you are fairly certain you're not getting your money, okay? So this might be if, for example, somebody has gone bankrupt, or let's say you have a customer and you have a huge dispute with them and you know they're not going to pay you. You could say that that debt is irrecoverable or it is a bad debt. You might also have heard this be called, if you do this in the workplace, writing off debt. Okay. So I want you to think about this logically. When we have a sales invoice for goods on credit, we debit the sales ledger control account, we credit VAT, and we credit sales, don't we? Okay. So if we're saying that this is a bad debt, we are effectively going to remove that invoice from our sales ledger control account. So if we have a bad debt, we are going to credit the sales ledger control account with the gross amount, because that is reducing the amount we are owed. Don't forget the sales ledger account is an asset. We are going to debit VAT because we can claim that back now. And we're debiting it because that's an asset, because we can claim it back. But the other debit for the net amount is going to go to irrecoverable debt. And the reason it's a debit is because that is an expense to your business. Why is it an expense? Well, think about this. You've sent somebody some goods and they haven't paid you for them, but they have still got the goods. So it's cost you money because you've sent them the goods and they're not paying you. So we've credited the sales ledger control account with the gross amount because that reduces the asset. That takes out the debt that's owed. We debit VAT because we can now claim that VAT back, because don't forget, originally we credit VAT because we pay it to HMRC. But the net amount doesn't debit sales, it debits irrecoverable debt, because that is an expense. It's cost your business money having this bad debt. Now, on your example in your slides, you can see here £700 debit to irrecoverable debt, £140 debit to VAT, £840 credit to sales ledger control account. What you can also see though is it showed you we need to prepare the journal for the sales ledger, because don't forget, anything you do in your control accounts must be done in your subsidiary as well. So not only have you had to adjust your control account, you've also had to adjust your subsidiary as well. Okay. The other reason then that we could potentially have to post a journal is when a business actually opens. Now, don't overthink this. What this means is somebody's at the beginning of their accounting journey and you're going to get given a list of things and you need to decide, are they debits or credits? So, assets, if you were given any assets, assets are a debit. If you were given any liabilities, liabilities are a credit. And if you were given any capital, capital is money that the owner introduces. So it's like a loan from the owner. Loans are a liability. Liabilities are a credit.